I'm Kathy Fettke, co-founder of RealWealth. I've been giving these quarterly updates for a long time, probably 15 years now, that I've been obsessed with trying to figure out markets, where they're headed, how we can be prepared, how we can see things that others can't see, but investors can, and how to interpret headlines, again, from a perspective of an investor versus maybe the typical reader of that headline. With every information, there's a different viewpoint, a different way to interpret it. So we're going to go over that today, and welcome. All right, so this is the big question. And again, I was on 3 really big stages this past week, and with each one, I would say, all right, who here thinks we're in a recession? And half the hands would go up, and okay, who thinks we're not? And half the hands would go up. And that's kind of where we're at. Nobody really knows. Of course, we've had the traditional, I don't know if it's even traditional, but it was widely accepted that if you had 2 consecutive quarters in a row of negative GDP, you were in a recession. And that's why many people think we are. But let's look at some other data and why people think we're not. So this is what you're going to see when you type in recession. I literally just typed in recession. This is what came up, and that's scary. So the headlines are a bit terrifying when you ask this question online. So you could see the IMF, is lowering global outlook, seeing recession risk, and there are certainly a lot of countries that are affected by all the things going on. And when you have in Europe massive increase in the cost of energy, they're struggling over there. Many countries who, if there's shortages, certain countries don't get the supplies, and those countries are really suffering as well. So again, when you type in recession, you're going to see all kinds of things, and it's terrifying. Now, how does it all affect you? Well, here in the US, the bond market seems to be expecting a recession when you have this inverted yield curve, right? 2-year treasuries paying higher than 10-year. So this is a John Burns slide, and again, lots of headlines on this inverted yield curve because that generally predicts recession. And then you've got articles like this that says, no, we're not in a recession. How could you have a recession when there's 11 million job openings, 2 jobs for every person who wants them? That's not typically recessionary, right? Usually a recession is job losses and a slowdown in the economy and higher unemployment. We do not have that. We have record low unemployment, so many jobs, people don't want to work. I don't know that people don't want to work, but there's maybe not enough people for the work that's out there. So we do know that the Fed has said they came in pretty harsh this last month with a third straight 3/4 point rate hike. This is unprecedented, at least certainly in my lifetime, of so many rate hikes. But when the Fed is raising rates, they're trying to slow down the economy. So the Federal Reserve is not going to raise rates in a recession. So to me, this was the biggest indicator that we're probably not in one right now, because the Fed would not be raising rates. And they said they're going to keep doing it through the end of this year and next. So that tells me that they're kind of looking at more of a robust economy, that a train that is going so fast, they've got the brakes on, they're trying to slow it down, but it's not slow yet completely. What of course we know that they're trying to do is curb inflation. And you look at this chart, we all know, we've been talking about this forever. Inflation has been soaring, just certainly over this COVID period. You could see there it all just sort of took off mid 2020 and certainly in 2021. And the only thing the Fed knows how to do is raise rates to make the cost of money more expensive, so people borrow it less. Their credit cards are more expensive, car loans are more expensive, and the cost of borrowing becomes more expensive, so that hopefully will curb the economy. But another thing that we've really seen, of course, is it wasn't even so much about the booming economy, which of course we've had as people got unlocked out of their houses, able to go out and do things again. There was a bit of a manic frenzy of spending, and there wasn't the product to support it. When you have a world that was shut down for months, and in some cases a year or more, and production came to a halt, And all of a sudden, then you open up the doors and everybody gets to go outside and they want stuff. It's hard to get all that up back and running. So we obviously had these supply chain pressures, and that drove inflation really high during the pandemic. But so much during those last 2 years were just weird. So it's not necessarily fundamental problems. It was trying to get the world started again after it was shut down. But the good news is those supply chain pressures seem to be cooling, and this is really, really important, big news. You could see that on the chart. Global containers, the prices were insane how much they went up, and just even trying to get your goods on the freight and then get them unloaded when there wasn't the labor, that was really obviously driving prices up a lot. So you could see it was like insane last kind of the middle of last year and through this year, and it's really come down. So again, this is good news for these supply chain issues that really contributed to this runaway inflation we've experienced. Commodity prices down. Look at that. You've got on the left there is the steel prices. They were up. They're coming down. Then we had copper way up, coming down. Lumber, ooh, we all know about that. It was just so increased phenomenally and back down. And the same with crude. So we're seeing things trend in the right direction. Certainly for those of us in, that are trying to get materials, we still have subdivisions we're completing in Park City, in Florida, in Reno, in Bozeman. So the last 6 months has been extremely painful, really the last year for anyone, home flippers, renovators. You couldn't get the supplies you needed, and if you could get them, you had to pay a lot more, because if you're the person selling whatever it is that everybody wants, you're going to give it to the highest bidder, right? So that was usually the national home builders. They had more money, they could get the supplies that were so limited, and they were able to pay more, and the rest of us little guys just had to wait for the scraps, right? But that is balancing out now. That's the good news. This is from Marcus and Millichap. I get these slides and these data from the many, many, many amazing people out there that are doing lots of research. So I have permission to use these, and just want to also share with you, these are great places to go to get data. Marcus and Millichap does regular updates, and I really appreciate the work that they put into it. And this is one of the things that we've seen is core retail sales. You don't usually have this kind of sales activity in a recession, right? You don't usually have record U.S. savings deposits and money market mutual funds like this, like we're seeing today in a recession. So again, I kind of compare right now as more like a train that has been going full speed, and they're trying to get it from going off the cliff, right? So just brakes on, but we're still speeding. You can look here if you wonder what today is compared to 2008, which a lot of people want to do because it feels familiar for those of us who went through it. And we still hold lots of trauma from those days in ourselves. Nobody wants to go through that again. And some of you maybe didn't go through it, but you heard about it and you don't want to go through it. One of the big differences is the banks failed. They weren't set up for the recession that came. Today, it's very different. There was $44 billion in bank reserves in 2007. Today, $3.3 trillion, plenty of liquidity out there. In fact, so much liquidity that banks are parking it with the Fed and doing a reverse repo. It's again, very interesting times. There's still an enormous amount of cash sloshing around. Maybe you're thinking, it's not in my pocket, but it's out there. It's out there. All right, so corporate profits, look at that, record profits again. Not a sign of a recession. And corporate cash on hand. So many of these corporations are well funded right now. So what are we in? What is this thing? It's like I said, I kind of described it as this freight train, but what sent this freight train off? And I think we all know, and I've talked about it all the time, that during the last, when you look at this chart, again, if we go back to 2007, there was $7.3 trillion in circulation. The M2, it shows the money supply, the amount of money circulating. So before the last Great Recession, there was $7.3 trillion circulating. You fast forward to today, it's 21. And they're trying to pull this money back out of the economy, but they really haven't done a very good job when you look at this chart. It's not coming out. Either it's been spent or it's still circulating. But they literally tripled. 7 times 3, 21, tripled the money supply since since 2007. So when we're trying to compare now with them, you can't. You can't. There's just too much that's changed, and it is this monetary stimulus, this modern monetary theory that was not acceptable when I was young. When you go back to the beginning of this M2 chart, 1971, we were tied to the gold standard, and politicians couldn't just print billions of dollars. And if they did, and I'm talking billions, there would be backlash. It would be front page news, and there would be an uproar when there was money printed. And you could see it stayed flat for a while. And then after the .com bomb, they started printing a little more. And then after the Great Recession, oh, you remember there was like trillions. And many people thought that's what helped create the recovery after that. COVID hits, and they just went all out. They just had a money printing party, and it went from, what is this line here? I think it was like around 15, 16 trillion to 21. It was at 20. It was higher than that at the peak. So just in a matter of years, just in a matter of 2 years, the amount of money that was printed was the same amount of money that was in circulation in 2007. Imagine that. All the money in circulation in 2007, that's what was just printed in the last 2 years. It's like we created this whole new economy of money. And of course, that's going to have an impact, right? Of course, that's going to have an impact. If you shut down production and you tell people they can't work, but then you flood the system with $7 trillion of money, where do you think it's going to go? What do you think is going to happen with that? So, obviously we gave some out, there was stimulus, there was just like money for everybody. All right, so again, where does this put us? Well, if I go back to that, I could go back to that inflation slide, but I won't. But if you just search home prices or inflation and you go back to 1971 and look at the charts, you can go on FRED, it's the Federal Reserve of St. Louis. They offer a lot of charts, and you can see that the price of goods and the price of things have kind of gone up in alignment, almost direct alignment with the money printing, because when there's more money circulating but the same amount of things to buy, prices go up. Of course, we know that new construction happens. I mean, new properties certainly come online, but not nearly as quickly as the money that's being printed. So it is, hard assets tend to go up in value when there's this much money printing. So in 2005, this is when I had Kiyosaki on the Real Wealth show. We were just in San Francisco at the time. I don't even know if it was a podcast yet. We were just a San Francisco radio show. When podcasts came out, Rich was the first one to go like, oh, this is cool. I'm going to take your show and upload it on this new thing called podcast on my iPod. And then it became an international show. But back then it was just San Francisco, and I was lucky enough to have a platform that got Kiyosaki's attention. He was able to come in and tell me what was going on at a time when there was a different way of stimulating the economy, a different way than just printing money. It was like, oh, let's just give money to anyone in the form of loans. Creating these loans could give 100% financing to anyone. Nina loans, no income, no assets, no problem. This was common. So it's kind of a similar, just giving money out almost for free, stimulating the economy, certainly stimulate the housing market. But I also knew that was going to not end well, because if you're giving subprime borrowers who have a history of not paying their bills, you give them unlimited numbers of homes that they can buy with no money down, that's generally not going to work out well, especially when you're not really qualifying them based on their income. In fact, you didn't even ask their income. You have no proof of it. Bottom line, stupid policy. Obvious it wouldn't work out, yet no one could see it, very few. And it was as clear as could be to Robert Kiyosaki and to me, because I didn't understand enough at the time. Just I understood that something was very, very wrong. Kiyosaki could see, yeah, sure, it's wrong. And these loans are going to reset, and people are actually going to have to pay them starting 2006, 2007. They're not going to be able to pay them. There's going to be foreclosures. and it's going to be an opportunity. And he explained how to reposition yourself to make sure you're out of the storm. You know, if you know the storm's coming, we just had a huge one, right, in Florida. You know that storm's coming. Preparation comes way before you know that storm's coming, right? You know, for us at RealWealth, all of our teams in Florida, they do not sell properties to our members in flood zones. And if you do buy in a flood zone, well, you sure better make sure you have flood insurance and really good insurance. But we've talked to all our providers in Florida, and there was very little damage to the properties that RealWealth. Nothing. I haven't heard a peep on ours, just absolutely nothing. And granted, you know that some of that's luck, but a lot of it is preparation before the storm hits. You know, there's storms that come to Florida, so you just don't buy something in the path of the storm. You know, you could stay in a high ground, so to speak. So they, you know, our teams there understand that, and they stay out of the way of the storms. And this was the same thing Kiyosaki was explaining. The preparation comes way before the world's really caught on. So he explained, you know, these sand states that had bubbled up way beyond any measure of affordability. The only way anyone in California could afford a home was either by lying on your application or only paying a tiny fraction of the actual payment, which was a neg-am loan. I mean, listen, negative amortization loan, a loan that gets bigger every time you make a payment. It makes no sense, but that's what people were giving. So seeing that that was going to just blow up the prices and asset values in these markets, you know, he knew to sell those bubble properties, take all your winnings, and go into a market that wasn't frothy, that wasn't bubblicious, a boring market, but where there's potential. And of course, you've heard me say this before. It was Texas. He had sold all of his winnings, all of his earnings in those bubble states at the peak. And it wasn't totally the peak. Like he sold around 2005. So the peak was maybe 2006, but that's close enough, right? So took those earnings and went to Texas, where values had not gotten out of line like that. So you might wonder why, you know, why had prices not gone up in Texas? They were pretty strict on their lending laws. They weren't doing what a lot of the other states were doing. You couldn't do 100% cash out refi or 104% cash out refi, get more money back than the house is worth. They didn't play that game. But also they were trying to recover from the S&L crisis of the 80s and just made Texas the most desirable place to do business. Tax credits and cheap land, and it worked. Businesses moved there, population was moving there, yet the home prices had not gone up yet because it had traditionally been a pretty flat market. So that's where it was this incredible opportunity to sell at the peak and take all that money and buy at the beginning of this market's growth. So, you know, Rich and I jumped on a plane and bought, I'll go back to that slide because I think it's interesting. We went and bought 5 of these, no money down investor loans. It's crazy. It was fantastic. But they still cash flowed, if you can imagine that. Just guess what you think this house cost. We were buying houses like this, brand new, gorgeous homes for 120 to 145,000. And they rented for 1% of that or more. So it was just fundamentals. These homes were in A-class school districts, safe neighborhoods, beautiful homes, didn't need any maintenance. They're new, and they were not on discount. We maybe bought them. This was the top of the market, so maybe got a few $1,000s off, but we weren't too concerned about getting a great deal. We just wanted the numbers to work, and we wanted to be out of the eye of the storm. We wanted to be on high ground when all this would fall apart. We wanted the best asset, and it was. It's an A-class properties, A school districts, 20 minutes from Plano, and all these massive job growth and infrastructure growth. There was freeways coming in, and hospitals and schools. So it just, you know, again, made sense, and we didn't care if we were getting some extraordinary deal. Now, I know that's like shocking to some people who only want, if I can't get it for 20% discount, I don't want it. And I understand that. There's much savvier investors out there than me. I just want what's easy. And this was easy. It's a beautiful house, new in the growth area, and it made sense. I went back and talked about it on the Real Wealth show. And this is when a woman called me and said, you know, you keep talking about how great real estate is. And I disagree. It's the worst thing I thought I could buy and retire. And it's done nothing but make me broke. I'm like, well, tell me more. She said she had these 3 properties in Stockton. She was self-managing. They were in high crime areas. So basically the opposite of everything I just said. High crime areas, bad school districts, old properties, breaking down all the time. She was self-managing, and they were a nightmare for her. Yet they were in California at this bubble, and these bubble prices of $420,000 each. So I'm like, look, if you just sell these, you're going to sell at the peak. We'll help you get some of these really nice assets that we just bought. And she did. She sold them. I wrote about it in my book, Retire Rich with Rentals. If you haven't read that, I actually have a new one. I just did the revision and it's coming out really soon. And I did the audio book version of the new edition. So that'll be coming out really soon. I'll let you know. But this story's in there. And basically she sold these dumps. These aren't the exact houses, but this is what they felt like to her. Took that 1.2 million. We took her to Dallas. She bought 9 new properties that rented for the same as the other one. So she had 3 problem properties renting for $1,200. She got 9 good properties renting for $1,200. She quadrupled her cash flow, got amazing benefits, tax benefits from having those 9 properties. She can write off all that new stuff in there. And she was able to quit her job and live the dream that we all seek from real estate, the passive income that will allow us to spend our time the way we want to. Had she held on to these, about 18 months later, when everything fell apart, these properties were $75,000 each. Again, that's kind of where we're at today. This is the time to reposition, make sure you're in the right areas and the right markets, and that will hold up no matter what comes around. And these wouldn't. You know, if a recession's coming, you know, it's going to be these areas get really hard to hit. If they're already high crime, you know, that's not going to change. So being in a good neighborhood is really, really important. So again, what we learned in those early years and what I wish I had just stuck with, because I've done all kinds of things, and this is the one that is tried and true and works, is investing in areas with job and population growth. Areas that are affordable, meaning the average income of the area can afford the average rent or the average home. You know, that's affordability. It's key. You don't want to be in a market where no one can afford what you have, or you're buying something thinking it's only going to make sense if you push the rents higher. Well, you don't know if you can push rents higher. We're in uncertain times. So to me, that's risky. So when preparing for a potential storm, you know, invest in areas with job and population growth, affordability, and in the path of progress. And again, the way you find out the path of progress is you find out where new employers are coming, where new freeways are coming, where the cities are investing in themselves, because they know where the growth is headed. All right. I can actually come off camera so you can see this better. There, now you can see the slides better. Okay. So one thing that we can get confused by all the time is that there's this talk of a real estate market, and we all know there's no such thing as a real estate market. It's like saying, wow, it's cold outside. I'm going to put a jacket on because I'm in Alaska, or no, I'm in Phoenix, but I just read that it's cold in Alaska, so I better put a jacket on. I mean, come on, Phoenix is going to be different than Alaska, which is going to be different than Florida, which is going to be different than Ohio. There is no real estate market. They just take averages. And recently we saw that the national average went down. That doesn't mean anything in terms of prices. When you see things like that, don't panic, because it's just taking averages. And yes, the average has gone down, as it should, as is expected. The housing market was out of control. They had to put a stop on it by raising rates, and the result is it slows down, and the intent is to get prices back to where they should be, and that is what's happening. But I don't think any one of you are necessarily in those markets. And if you are and probably holding it, you'll be fine later. Just keep holding. All right, so looking at this chart in 2013, I think this was, I was asked to debate Robert Shiller, who, as of the Case-Shiller housing index, and he was saying that it was a dangerous time to buy. That would have been right around here. He was saying that it was dangerous, people need to be careful. Now I could see that at this point, but at this point everybody was saying, oh, it's such a good time to buy. Even the national, the chief economist of NAR was saying that, came out with a book saying that prices are going to continue to rise till the end of the decade. That he was not right. So yes, dangerous time to buy. Is this a dangerous time to buy? No. But if you're looking at data, you might, if you're just looking at the past, you might think it is. So if you're here and all you're watching is prices rise and you don't know what's past this, you might think, and all you can see is this chart, you might think, oh my gosh, I better get in before prices get out of control. Or if you're here and all you can see is prices going down, you might think, oh, I'm not going to buy till prices go back up because this is dangerous. Well, that's a metric we shouldn't look at, because if you're only looking at the past, you're going to be wrong. You've got to look at the future and the signs and what makes sense. So at the peak, did it make sense to buy certain properties? Obviously not. The person who bought those 3 properties in Stockton from our client paid $420,000 for a property that rented for $1,200 in a horrible part of town. Why would you do that? At the same time, we were buying in Texas, and the rents covered everything, and there was cash flow, and we knew that there was growth. Now the growth didn't happen right away. Prices stayed flat, but they didn't drop. But then when all those jobs hit and people were moving to Texas, it took off. So the metric shouldn't be so much looking at data as looking at the numbers. Do these numbers work or don't they? Is this a good asset or isn't it in any market? Okay, so jobs. And of course, you can see when we were buying in Dallas, this was the pricing, and it started to go up, and then the last 2 years just went crazy. Just went crazy. Prices so up in the Dallas area. Again, that's so much to do with I personally think it has to do with the laws in Dallas, because we learned in 2020 that there were certain markets that would stay open and keep business a priority. And Dallas was one of them, and more jobs moved there during COVID, and look at what happened to home prices. You look at Austin, and we don't invest in Austin simply because we find better cash flow elsewhere, but Austin's a great market if you certainly if you time it right and if you can cash flow. If you look at this, the recovery of high income jobs percent of pre-COVID, Austin was way past their pre-COVID peak by June of this year in high income jobs. That tells you a lot. Dallas second, 114% recovery of high income jobs since before the pandemic. Then Jacksonville. You can see why we love these places, right? And why we get excited about investing here. Raleigh, Durham, Tampa, 108%. So job growth during the crazy 2 years. Seattle, Nashville, Atlanta. Again, you can see why so many of the markets that we promote are on our list, right? And you can also see why some of these are not, like San Francisco, LA, even though I own property in LA, it works as a short-term rental, but you've just got to be aware. You look at Austin again, high income growth overall. Las Vegas, Dallas is up there number 2 again, Jacksonville, Austin. So if you want to be in an area where the wages are growing faster than it has, this is the list you want to be looking at. We just did a webinar on Indianapolis properties. We're so happy to be working with this group. They've been providing, they've been so busy they haven't been able to get us any inventory. It would sell to the general public before they could even get it to us. So a lot of people are scared about investing today. And I'm saying, are you kidding? We're in business. We're back in business, people. We can go and actually make a deal. There's actually inventory for us in these growing markets. There's this little window of time where, the momentum is still there. These jobs are still being created, but we've got a little relief in home prices and in competition. We can finally promote Indianapolis again. I love this market. So definitely talk to your investment counselor about those properties. It's exciting. And same with Dallas. We've got our single family rental fund. You can see why we're buying homes as low as $80,000, renovating them to really, really high quality to attract all these new high income earners. Jacksonville, our team there is excited about short-term rentals in that area. And, again, Orlando, our team there, she's got lots and lots of opportunity. Tampa, certainly. These are the markets that are strong and will be strong moving forward, recession or no recession, because there's so much migration. Here we are. So here's the migration in 2021. And, if you're in California, you just have to know that, we're losing population. And there's parts of California that are growing, so a lot of people were moving from LA proper into the suburbs. So some of the suburbs are doing really well. But overall, California is losing population because of its high tax and high regulation policies. Same, got to be careful of some of these other states. Then you look at Texas, lots of migration. Florida, of course, and all the gray is pretty neutral. Okay. So when you've got this kind of migration and you're talking about, say, someone moving from New York to Jacksonville or from Los Angeles to Jacksonville, in 2020, it was so stupid cheap, 66% cheaper to move from LA to Jacksonville. You could see why there would be a California wave moving to affordable places. And you might think, well, now it's too expensive, but not if you're from LA. It's 63% cheaper still to buy in Jacksonville. So when you talk about, when you see the demographics shifting and maybe these people just want to rent before they buy, it is ridiculously cheaper for those who are migrating. Again, into the Tampa area, from New York to Tampa, it was 53% cheaper, now 42%. So a little bit less cheaper, but still pretty darn cheap. If you're leaving New York and your job just moved to Tampa, or you can work remotely, that's going to be a comfortable situation. So over the years, I've been just brought on to different shows to help interpret the headlines so that we can read it from a different perspective. Because if when you're seeing things, headlines like affordability, I'm just trying to think of the headlines that are out there, but most homes unaffordable, what you want to interpret from that is that if the mortgage rates have doubled over the last 6 months, and now all those people forming households can no longer afford to buy a house, what does that mean to you? Do you read that headline and say, oh no, the sky is falling? Or do you read that headline and say, these people need a home, and I can provide it. I have the means to be able to buy that home and rent it to them. That's the way you can interpret those types of headlines. It's sad. It's very sad that people won't be able to buy their own home, but they still need a home, and you can provide that for them. So again, the headlines need to be interpreted from a different perspective. And when we see that sales are down, sales are down 80% or something, it's insane. So who's getting hurt by that? Who's affected? Well, obviously real estate agents, mortgage brokers, anyone in the sales side of real estate, flippers, home builders. It's hard right now. Who's this good for, though? And this is what's not being said. We went from an insane seller's market over the last 2 years. Insane. I don't even know if it was this bad in the 2000s. It's just 90 people on the wait list to just go make an offer on homes. People not doing inspections. One day, a house goes into contract in one day with multiple offers way over asking price. Insane. That's called a seller's market. That means the seller can do whatever they want. They can say, you know what? I don't want you to do an inspection, but you still have to come in 100,000 over. It's the seller in power. Now, when you read those headlines and see that sales are down 20%, who's in power? You are. I mean, if you already own the asset, we'll talk about that in a minute. If you've already come into the space of real estate and you own property that's cash flowing, you're locked into low rates, you're in a market that's strong where rentals are needed, just ignore the headlines. It doesn't matter. They're not talking to you. They're talking to the home buyer who was hoping to own a home. And now that person can't. So again, it's a buyer's market. This is the time to buy. And I can't tell you how many times people get this wrong. They buy in a seller's market, giving all the power to the seller, and they get a bad deal. And then when it's a buyer's market, they freak out. And it's like, it's your turn. This is your turn. You get to get a good deal. You get to negotiate. On top of that, you get leverage. Sure, it's not the leverage it was, but we have a lot of lenders who are still, a lot of the non-traditional lenders have pretty good rates right now. So, just check into it. We have a list, or talk to our investment counselors at RealWealth. And a lot of the sellers, because remember, it's a buyer's market, the sellers it's not all in their favor anymore. So you know what they're doing? They're paying down points so that your mortgage rate is lower. Almost all the teams that we work with have been able to negotiate where we can get extra points, extra money to pay down points so that you can still get great leverage at good rates. Is it going to be 2%? No. Is it going to be a normal rate? Yes. If you think 5 or 6% is a high rate, you're wrong. It's a very good rate. It's just not the rate you would get during a pandemic. During a pandemic when nobody's working and they're trying to stimulate the economy, they're going to lower rates to well, it was 0% overnight rates, which translates into about 2 or 3% borrowing rates. Now we don't have a pandemic, so things have bounced back to normal. This is normal. And the only thing that's not normal is the intense rental demand, which brings us to cash flow. And then the tax benefits on top of that. And the asset protection where people don't even need to know that you own the property. And that over time, values increase. Because right now there's such a panic. People are so worried that this is an unbelievable time to negotiate and get deals. As soon as rates go down again, and I do have a slide showing when that might be, it's going to be a buying frenzy again. So there's a little window of time where you can take advantage of the fear out there, knowing that over time, values increase because of modern monetary theory and all the money printing, hard assets increase in value, and then generational wealth. And one more thing that we talked about at the Bigger Pockets conference, there was a really good economist. I'm going to try to get her on the Real Wealth show and have her come speak for us. It was mind-blowing. And I had heard this and thought about it, but if you know that right now inflation is running around 8%, and you have $100,000 to invest, you're going to have $90,000 to invest by the end of the year because inflation is eating up your money. It's 8%. So if you just sit on cash, you're losing 8% every year. Whereas if you borrow money, let's say you get a 6 or 7% interest rate, that's below inflation. And if you're borrowing below inflation, that's keeping you ahead of the wave instead of underneath it. I went out surfing this morning and I haven't been out for a while and I was timing it wrong and I was I was the one under the wave getting crashed by it, not the one riding it. It was not impressive at all. But that's what it feels like when you're sitting here with cash and inflation that's just making it worth less, 8% less every year. Whereas you could borrow money for less than inflation, which makes it a negative interest rate. You're getting at negative 1%. borrowing money for cheaper than what it is and buying assets that increase with inflation. So it's just like you have to look at every headline from the perspective of an investor, and it would change everything. I was at, like I said, Bigger Pockets, and there was 2,000 investors in the audience, and I can't even begin to tell you the stories they were telling of the deals they're getting right now and how excited they are, and like they haven't been able to get deals in 2 years, and they're very, very, very bullish because they're looking at the headlines differently than most people. So, and then of course at Real Wealth, one of the reasons that we love our model is that, let's say you have $1 million house in LA that rents for $4,000, but maybe you only have a loan for $400 or $500, so you're calling that cash flow. It's really not cash flow because you've got all this debt equity in there. And if one thing happens to that house, it's vacant. Versus you take that and you sell it and you buy 10 $100,000 houses. Then you have, and that's harder to do, but I'm just using this as a model, and it's still possible, by the way. Now you have 10 houses that if 1 or 2 or 3 or even 4 go vacant, you're still making more money. You're still making money. And it's diversified. Instead of that one house in LA that might be on a fault line, you can't get insurance for it, you've got 10 homes, maybe a few of those in Ohio where they don't have water issues. If you're worried about the West Coast running out of water, you go buy in Ohio. If you're worried about global warming, you buy in Ohio or Detroit, right? Or somewhere where it's colder and more north. If you want growth, you want to go where the demographics are going, you go to the southeast and stay out of the flood zones. In this way, you are diversified. And then get some halfway through too. Get some in Kansas City and Dallas and Indianapolis, like I said. So you're diversified. So if you still have that question of but is housing going to crash and are prices going to go down, and do I want to buy at the peak, and why would I buy now? I'm just going to show you a few slides that will be different than what you see and hear in the headlines. This is inventory. Again, this is trading economics slide. But even though inventory has increased, it came from a really, really, really low. It's the beginning, just a year ago, beginning this year, it was way too low. It's gone up because of rates, but not that much. Inventory is still really, really low. It's going to take a while. We need to get back up to here to be sort of on the trend line, and we're not there yet. So we need to see a little bit more inventory. Are we going to get it? It's kind of tough. New listings are down. Like, listings are up more than they have been, but not new listings. And look at that. I mean, it's kind of pathetic and scary because of one thing. We know what it is. 73% of mortgage borrowers are locked in at rates below 4%. Why would this 34% of the population trade the home that they bought that has an enormous amount of equity and is locked into a 2% rate when they would probably just put that on the rental market, or just hold it or renovate it or whatever? You'd have to be pretty desperate to leave that. And then look at this, 39%. I mean, unbelievable. 18% at 4 to 5%. So these people are probably not selling. Why would they? At the same time, since 2007, we have 14 million new households. So more people, not a lot of new supply. And right now, this massive python, elephant in the python, that used to be the baby boomers. Now they're starting to, fade off the chart. But here we have this massive demographic that is forming households at a time when listings are down. It's a very interesting time. When you look at the change in resale listings, you can see that Austin, again, this is John Burns' slide, Austin has had the biggest year-over-year change in resale listings. So that was a market that was too hot. It was one that I was cautioning people. I don't like going into markets that went up 40% in value. That to me means you missed it. You should have got there 2 years ago, not today. So the listings have gone up. Tampa 2, Las Vegas. But what does this mean when you see this headline? You're like, oh, is Austin or Tampa a terrible place to buy? Well, look at, in the big scheme of things, all inventory, there's only 2.6 months supply. So yes, it's gone up, but it's gone up from a horribly unhealthy low. It's getting healthier now. This is better. 4.5 months supply would be really healthy because you shouldn't have to make a rash decision when buying property. You shouldn't have to make a decision in 1 hour or 1 minute. You should be able to get your inspections, come back, have a negotiation. Who's going to pay for this? Now it was just all seller power. It was like, you're going to pay for it, buyer. Now it's going to be a more fair and balanced market. It is better for buyers. This is the buyer's market. I can't emphasize that enough. You can wait till it's a seller's market again. That'll probably be next year. Or you can buy in a buyer's market, which means you have the power. Okay, and then you want to look at the markets that have the lowest supply. See, Orlando. I hear people worried about Orlando. I'm like, what are you worried about? There's nothing there, man. There's the growth. It's a completely different economy than it was 10 years ago. And there just isn't the inventory for sale. Tampa, very low. Remember, I showed you that on the slide that Tampa listings have gone up, and thank goodness, because if you wanted to buy in Tampa, now's the time. There's a little bit more there for you. Okay. So the place where unsold inventory is really stagnant is Northern California. So that could be if you were trying to buy your primary, not maybe necessarily rental, but that could be a time because there's more inventory than anywhere else. Prices are coming down. So again, not something to be so terrified of, but just to say that it could be a buying opportunity if you wanted to settle down in Northern California. I don't know that it would make a great rental. The Midwest has more. Look at Florida. Again, just inventory is too low. So it's probably still a bit of a seller's market in Florida. Texas, again, still pretty low. All right, one area, again, this was from Zonda. I don't want to badmouth Phoenix by any means. I have lots of friends there. They did get a lot of new construction started. So over 19,000 units coming. Now, will there be enough demand in Phoenix to absorb that? Probably. There's so much demand. But this would be one market I would pay attention to. If you want to own there or live there, you might have more opportunity now as prices might be coming down in Phoenix because of the new supply coming on. Still might not cash flow as well as other places though. And then again, this is from Zonda, just kind of showing sales pace, comparing it to 2019. The yellow line is 2019, purple is today. This just shows, is where we are today comparable to where we were in 2019 before everything got weird? And all the cities on the left side, these are the ones where the sales rate was faster and higher in 2019 before the pandemic. So something to keep in mind. These areas they're not selling today. Whereas on the right side, these are the areas that are still, in spite of higher rates, having more sales than in 2019. Look at Tampa. Again, there's a lot of people saying that Tampa is going to correct, and I disagree. Not when you see this. Low inventory and sales rates higher than they were in 2019. Same with the Orlando. Houston's a little bit less. Dallas a little bit less. Of course, we're in North Dallas, so that's different. If you're worried that there's going to be massive foreclosures, you need to really study this slide. Really study it, because it's just the data is not supporting that thought. The people, these blue lines, the people who have gotten loans for their properties mostly have over 760 credit scores. And look at that. Most loans have been from strong borrowers who pay their bills. This was not the case in the 2000s. It's a tiny percentage of strong borrowers, a much bigger percentage of subprime, hardly any subprime today. But back then, it was pretty common to give someone a loan who had no history of paying things back. Again, it's just inverted. It's completely flip-flopped. So if you think all these strong borrowers with good credit are just going to say, you know, this low payment and this low interest rate and all this equity in my home, I'm going to just walk away from that. That's not happening. Especially given that the mortgage payment today, with those low payments that people are locked into, and it was mostly 30-year fixed, they are the lowest payment compared to income in history. So when you're worried about the current housing market crashing, you just got to look at the slide and say, who in their right mind would say, you know what, times are tough. I'm going to stop paying my mortgage and I'm going to find a place to rent that's 3 times what I pay now. No, it's not going to happen. Okay, so this is John Burns. He's been really good. He does studies for new home builders, and they're very, very intense. And I reached out and I said, can I please use your slides? And he gave me permission. In fact, I just did an interview with him. You can listen to him on the RealWealth show, and it was pretty negative, but this was positive. This was super positive that the bond market is assuming mortgage rates will be at 4.9 to 5.6% next year in the next couple of years. So if you were one of those people worried that rates were just going to keep climbing, this should give you some relief. The mortgages follow bonds, and if the bond market is saying this, it's important to pay attention. You would have to really think that Jerome Powell wasn't going to get what he wants at the Federal Reserve, that they're not going to tackle inflation, that it's never going to come down, that we're never going to solve these supply chain issues, that people are never going to slow down on their spending, as things get more expensive. It's just not the case. So inflation is going to get under control. And I think we're going to see some really good numbers at the end of this year, because the year-over-year numbers are going to look better because inflation got really ugly last fall. And now we're going to be comparing today's inflation with last year's high inflation. So it's just not going to look as bad. So that's good news, I think. Anyway, it's my opinion and John Burns that we're going to see rates stabilize, and that's a healthy rate right there. Okay, so to be recession-proof, these are the things we've learned in the last recessions that we've gone through. The things that we wish we'd done, the things that we did do. We did a lot of things right, and then we veered from what I knew to be right and did other things that weren't as straightforward. We know cash flow is king. So, when buying land and developing it, you're not getting cash flow. Oh, now it's moving. Okay. You're not getting cash flow on land. So it's speculative. And you just have to know that. There's nothing wrong with development. When you time it right, it's phenomenal. Our first, developments, they killed it. People were making 30, 40% returns. But you have to just know it's speculative versus cash flow. If you're in a good, strong market with a property that people like, they want to live in, it's safe, it's near good schools, it's near jobs, and a strong diversification of jobs, you're going to have, and you have a big pool of renters to pick from, that's recession-proof, cash flow. And then making sure that you have plenty of cash reserves on hand. So keep enough cash reserves, not too much, because remember that inflation is not nice to your cash, but enough that if there are job losses, you can cover that. You can go through the eviction process and cover any vacancies. Again, I don't think you'll see that many if you're in the kind of markets that we recommend, but don't over leverage. Make sure that your payment, that it cash flows. So, negative cash flow is no fun. I've done it. I don't recommend it. But keeping your leverage low, and especially in multifamily or in any commercial loan, keep that leverage low, because that could be pretty scary if the value of your multifamily goes down and you have to put more money into the deal. Excuse me. Know that financing can disappear or change. So if you're not in a long-term debt, you're in just short-term debt, you just need to, and by short-term, I mean bridge debt. I'm not talking about a 5 or a 7 or a 10-year ARM. I think those are great because I really do believe that rates are going to go down, and If you can just get in a short-term loan, you can get a great price today and then refi later. And if you get a 5, 7, or 10-year ARM. But either way, just maybe pay points and get a 30-year, get a good loan that you'll keep a long time, because financing can change. And what's available today may not be available. We learned that in 2008, that loans, it was so easy to get construction loans and get no money down loans, all kinds of things. And all of a sudden, by 2008, those options were gone. Couldn't even refi. It used to be that you could have an unlimited number of investor loans. And then by 2009, you got limited to 10. If you had more than 10, you couldn't get another loan, not conventional. And there weren't very many other options. So getting in a fixed rate will give you the most security, but having at least be fixed for 5, 7, or 10 years. And the right market, of course. The right market matters. Okay. There we go. So if you haven't already looked at this, if you click on the Invest tab, you'll get a lot more information on these different markets. These are all markets that we think are pretty strong. Some aren't on this list anymore. Group investments, if you don't want to do any of the work and you just want us to do it, and you're accredited, you have to be accredited, you can look at our growdevelopments.com page, grow, G-R-O-W, developments.com, to look at syndications. We are raising money to buy homes in Texas, and all you have to do is invest, and you don't have to do any of the work. We do it for you. That's growdevelopments.com. And of course, you can connect with one of our investment counselors. They are highly experienced. They all own in the different markets that we recommend and with the teams that we work with, and can tell you firsthand how it's going for them and the conversations they're having with, thousands of our real wealth investors. Okay, let's take questions. I still have a voice. First one, missed you in Austin. Missed you too. I was at, oh my gosh, I was at a CPA event. I'll try to remember the name. This question is, you don't believe the Fed will create the recession? I think that they're really trying to. They're raising rates, but I actually think that the number, I don't think that they're going to. So it will be, there's already a recession in housing. It's already pulled back, right? We're already seeing price decline. So you could call it a recession in housing. I think that would be fair, but a needed one and a healthy one. And again, a buying opportunity. So yes, I think that the Fed is trying to create a recession, but it's going to take a lot for them to clear out what they've put in. And I will bring this economist on that will explain how hard it's going to be for them to create a recession, basically. All right. Do you think the rise in savings is from investors outside the US? I'm not sure. I don't think so. Okay. Are you hearing about more evictions? We just had our property team call yesterday, and I do not remember hearing anything. If anything, rents are more in demand, rental properties are more in demand than ever. So I think what I would like to do is make sure that our property managers are giving you all real-time updates. That's what we did during COVID, and I think anytime there's like a shifting market, it's really nice to hear that. So I do want our team to do more of that and do regular updates so that you know real time what's happening. But no, I really think it's the opposite, because people are priced out of being buyers, and there's still a massive demand out there for housing. It's just they're forced to rent. I think I am seeing a slowdown in short-term rentals though. Let's see. Let's see. I'm sorry, I'm going through these questions. Insurance is insane. Yes, insurance is kind of going up everywhere. I wouldn't, I'd be careful about investing in Florida too close to the beach. And new homes tend to be lower insurance. Okay, what cities do we recommend now? We're still, all of the markets that we're in, I love, and we've loved because those same fundamentals are there. Everything that's on our website, the fundamentals are there. The difference is now you can finally get something. I mean, we loved Indianapolis, but our provider couldn't get anything. There was multiple offers on everything, and foreclosure markets shut down. So they just couldn't get inventory. And you had the iBuyers coming in. It was a frenzy. So all the places that are on our list, the fundamentals and it's all still there. It's just that finally there's not as much competition, and we have the power as buyers. We can have them like I said, pay extra points so that we have a lower rate. These are things they would just laugh at you. They'd scoff at you. I mean, a few months ago, they were like, "You're asking a question about the property I'm selling? Either buy it or don't." It's better today. That was unhealthy. So I still like Tampa. I still like Orlando, Jacksonville. I like, the areas in Texas that we're in, but definitely talk to an investment counselor. Oh, Cleveland we have a new team in Cleveland that has cash flowing property, and that market is high on medical. And we've got a big baby boomer aging population. So medical towns are great. So if you're looking for cash flow, definitely check out our new Cleveland team. How would I advise realtors? Personally, I feel like realtors could, if you could work with builders and have them negotiate the pay down of the the points, pay points, so that the buyer can come in with a better interest rate. I think now is a really good time to help your buyers finally get in the market. If they can lock in that rate and get a better discount. So being really savvy and really giving that value add, and then also working with investors, because if somebody can afford to buy the property and rent it, there's tremendous demand. Will PowerPoint be available? Yes, it will be uploaded on our site. Is Tampa a good buying opportunity? Absolutely. We love Tampa, and we have a great team there. And he's back. He's got new homes because he's able to negotiate with builders now, and he's getting some discounts. That's exciting. We didn't see that before. And he's back to being able to get foreclosures. They came to a stop for several years, and now it's trickling out a little bit. So he's back to the turnkey model too. So yes, we love Tampa. If corporate profits and the economy is so great, why is my 401k down? Because the stock market. It's just, why we don't invest in it. You've talked about different opportunity markets. What do you think of Fort Collins? I don't know enough about Fort Collins. I'm sorry. Hi, Nick. Said he's agree with me on my outlook. Awesome. I hope we're right. I'd rather be positive than negative. and just understanding market cycles. It's so funny, the human mentality of, I'm going to buy in a seller's market when the whole world is buying at the same time, versus, well, I'm not going to buy the same property today that I can get for cheaper because no one else is buying. I need the crowds. No, you got to go against the crowds. So the dynamics are there. You just have this moment of opportunity where you have a little power as a buyer. El Paso, I think it's a good market. We don't have a team there. It's going to be probably lower income, but when I was there recently, I met with a realtor who said it's been a really super hot market. So just make sure there's enough that the salaries are continuing to increase there, and that there's the kind of jobs that would support rentals. Okay, I'll just come back on camera. Hello, everyone. Let's see. I would like to join. Oh, the syndication. Okay. Yeah, you just go to growdevelopments.com. You do have to be an accredited investor because it's regulated by the SEC. If I have properties that have equity, is there a percentage of leverage you would recommend? This is such a tough question because so many people are locked into low rates, but they have a ton of equity. So, you don't want to refi and lose that great rate, but you want to take advantage of the equity. So one thing might be talking to banks to see if you can get a second. If it makes sense to refi, but I would wait to refi because I do think you're going to get a better deal later, unless some of the lenders that we're working with will do a blanket loan, a loan on all your properties, and sometimes the rates aren't that bad. But again, if you're locked into 4 or 5%, you don't want to probably touch that. So I don't know how to answer that question. If anybody else knows how to answer the question of how do you tap the equity in your properties without losing that awesome interest rate, I'd love to hear the answer. Okay. What about Airbnb? We have 2 Airbnbs that were unbelievable the last 2 years. They have come to almost like complete stop. So I think from what I understand and the messages I get from Airbnb, profits are way down, but the use of Airbnbs is up. So I think a lot of people came into the Airbnb short-term rental market over the last 2 years thinking that the activity of the last 2 years was normal, and it wasn't. You had people who were getting paid stimulus checks and weren't working. So what are you going to do? You're going to go travel. So it was an unusual last 2 years. Too many people were thinking that was normal, based all of their numbers on that, and I don't think it's going to work out well for them. So, if you're going to be in an Airbnb, you just got to be careful of local laws. Go on AirDNA. AirDNA will help you understand if it's oversaturated, because you'll be able to see all the other properties in your area. There's a fee if you want to really drill in, but you could see what the competitors in your market are making, how many nights their place has been rented, and how much they're making. So that would give you an idea, but you got to be careful with short term. I still like them, but you just got to make sure you're buying in the right place. Investing in new construction is better right now than it was. In fact, buying from builders is better right now than it was, because they're negotiating. They got to move inventory, and they've got loans, and we've got great deals I'm excited about at Park City. If anybody's interested, it's going to be a high net worth thing, but I will share it with my real wealth people. That if 8 of you wanted to buy one of these, or 4, whatever, a group, that's what I'm doing. You can, and if you spearhead it, it's kind of like you're almost doing your own syndication, where you would buy it, you can sell it to a Picasso or an Ember. That's what I'm doing. They sell shares. So there's 8 owners total. So if you buy it and build it and you get the upside, you can still sell to the 7 other owners and keep your 1/8 share and get 6 weeks use of the vacation property, and be in almost no money after you've sold it. So I think for somebody with, maybe a 1031 that has $500,000 they could put into the lot and then get the loan and build it, you could be in that property and use it for 6 weeks in a vacation town and have almost none of your own money in it. So contact me if you're interested. But new construction, it's been horrible, but you might be able to get some deals now, because there's a lot of distressed builders. You might be able to buy some lots. I think that's something we'll be looking into, and same with multifamily. I think there's going to be a lot of distress in multifamily. If you're looking at any multifamily projects and they haven't discounted based on higher interest rates, be careful, because there's great deals in multifamily in a distressed situation. That's what you want to be focusing, not paying the same price you would have paid 6 months ago with higher interest rate. I'm seeing that a lot, and I don't know how they're going to make it work. We're in Tampa. If you go on RealWealth.com, click on the Invest tab, you'll see the Tampa team, and you can reach out. Our team there represents all areas in and around Tampa. Seems like we just sold our North California property in time. Yes, you did. Good time to buy, though. Our guy in Tampa, you'll just go on our website, realwealth.com. You could talk to an investment counselor, and also you could once you join, you get all the information and contact information on our website. To be fully transparent, Real Wealth, we're a broker in California, and we have found teams across the country that have a brokerage that we've trained to our standards. I mean, they already know what they're doing, but we are like, this is the standard, this is the buy box that we're looking for our investors. We want, you organize the property management, the insurance, organize everything so it's a done for you investment, and then we receive a referral fee out of the commission. So you're not paying more to use our teams; they're paying us out of their broker commission, because it's broker to broker relationship. So when you go to our website, that referral is made, and we are still here for you and to help you and to oversee these teams and make sure they're living up to our standards. If you go onto the RealWealth site and type in real income property standards, that's what we expect them to be providing to you. And you can get your inspection and make sure the inspector goes through it and says, yep, this looks like it's RealWealth standards. Unless it's a new property, then it's obviously new. So that, again, that's our value add to you. Is we find these teams, we've worked with you, masterminds with them, they share their best practices, and they take care of RealWealth clients because they want to stay on our referral list and they want to, have us send great people to them. So, that's only going to happen if they take care of our members. Again, that's RealWealth. If you just log in, you'll get that information. Was Tampa affected by Ian? We just had our call yesterday, and it was very minimal. I mean, it's the normal trees falling and stuff like that, and some fences broke and stuff, but very, very minimal damage. And again, like I said at the beginning, it's not an accident. They bought specifically in areas that don't have a history of getting hit by hurricanes and are out of the flood zones and are solid, not brick, but the, things, the block housing. They know what to buy because they're from the area and they know they're not going to sell you something that's going to blow away in the wind. Okay, would you consider a cash out refinance to purchase additional properties? I was just saying, I don't know. I really want someone to tell me their opinions on that. If you do a cash out refinance and get out of a great rate, I don't know. It's a tough one. Would investing in submarkets around Austin, like Manor, Lockhart, I don't know these areas. All I know is we haven't really focused on Austin because the numbers didn't work as well as Dallas. Obviously, Austin's a great market. It was way overvalued the last year. Now that bubble is popping, but I don't know that it's burst enough to make it cash flow well. So that would be like, if you're moving to Austin, great. This is a great time to buy. If you're buying rental property, my guess is it went up 40%, it hasn't gone down 40%. So you're still paying a premium to be in Austin. It would not be my first choice because I doubt it cash flows. But if that's a market you want to be in, go for it, because now it's going to be cheaper than it was 6 months ago. We love Indianapolis. We've got a wonderful team there. They just presented some properties. I think most of them sold out, but a couple of them fell out of contract. I think the person couldn't get their financing. So just talk to our investment counselor to make sure, but they just announced some new homes that they promoted. Let's see. To have one of our investment counselors answer your Atlanta question, because I don't know the market as well as they do, but talk to your investment counselor. I think the area you're talking about in the suburbs is maybe doesn't have very high rental returns. So I don't know that that's a good area, but talk to one of our investment counselors. Let's see. Somebody said, if I've got some, it looks like a builder here saying, I'll discount properties that we have for RealWealth buyers. So again, if you've got properties and you're a builder, please speak to our team. Just log in. You can actually just reach out to, let's see, who would you reach out? Info or hello@realwealth.com and let them know that you'd like to have somebody from our team look at your properties if you want to sell them. That's a good question. There's a question, have rents gone up too high that people can't afford them? This would be a great property management question. And I would say certain areas probably have gone up more than others. We stay in the median price. So we make sure that we're always in that affordable range where the average person can afford the rent. So we're not buying the $1 million properties in Tampa. We're getting our team there has them still around $200,000. So it's totally affordable for the average person. Best resources. Some of the resources we use, John Burns Real Estate Consulting, definitely go on there. City-data.com. There's a whole lot of things you can do. Bigger Pockets has some really great tools if you go on their resources. Lots of ways to get it. And then just going to the local city Chamber of Commerce and finding out what's going on. Talking to property managers, they know so much. Lenders are doing, someone asked if we could, accept non-accredited investors in the fund. And unfortunately, it's just an SEC thing. It costs so much more to have a non-accredited investor in a fund because you have to have, there's more requirements and more hoops. So it's really not cost effective, and I hate it. I wish we could just let anyone in the fund. It makes me mad, but it's not my rules, and I'm really sorry. But at the same time, that's why we have so many teams across the country to help you build your portfolio so that you can become accredited. The more they help you get into these properties, maybe through a BRRRR, where you get enough equity that you can refi and take your cash and buy more so that you are accredited. But with the funds, they're just really strict. Lenders are doing HELOCs, home equity loans. Good. So that's one way to tap the equity. Someone said, how do we manage real estate from a distance? That's what we do. That's what real wealth is. Most of us are from high-priced markets, and we've had to learn how to be good at investing out of state. And you have an unbelievable resource with our investment counselors. We handpick them from our membership. These are people who've been buying, they've got portfolios, they know the markets, they're super active just for their own portfolio, and they're so happy to help you, like legitimately makes their day to help you. So talk to them, they've figured it out, they know the property management companies we work with, and I'm not kidding when I say like they are living their purpose of helping you build your portfolio the way they have. I'm interested in Park City. Awesome. Reach out to me, Kathy at RealWealth. I don't know where Picasso is. Yeah, you'd have to go to their website. Okay, this will be uploaded on our website if you missed the first part. Let's see, if rents, a lot of people are asking about rents in Florida. Talk to the teams in those areas and talk to the property managers because they'll tell you what's going on. Ocala, yep, we're in that market. What do we predict for home prices? Yeah, it just depends on the market, of course. Which if prices, I would say right now would not be a good time to buy for price growth. Now is the time to buy in an area just to stay out of the storm, just to be in a good cash flow market that has lots of job diversification, lots of growth planned, and just sit tight. Buying for prices to go up is kind of iffy at this time, but at the same time, there's this little window where once rates go down, it's going to be a frenzy again. There's just so much demand. There's just such a huge population. Someone said submarkets in Austin are good. Someone said do a HELOC on your primary. That's one way to tap in the equity and leveraged. You can get it cheap. Someone said I'm doing the all-in-one loan with Chaley Ridge. I actually did an interview with her. It should be coming out soon. It's an all-in-one loan. It's really different. Scared me a little bit, but I'd like to learn more about that. And Leah, one of our investment counselors, said check it out. It gives you a line of credit. It's amazing. Talk to Leah about it. So Leah, I need to talk to you about it because it scares me, but it sounds amazing and it's pretty common in other places. Okay, how do you feel about the Houston market? Houston can get kind of saturated. It's a little bit more volatile. So I were going to choose a market, it would be Dallas or San Antonio or Austin. But if you have a good, find a good property and a good market in Houston, you'll be fine. But I would still choose Dallas over it. Any places under 100? Sometimes, yeah, I don't know. Investment counselors, where can people buy for under 100? I know in Cleveland it's close to that. It's real close. And there's a team in Detroit that's lower than that, but it can come with its own set of problems. If you're buying too cheap, it might be an older home, so the acquisition price is low, but then all the repairs add up. So to get a fully renovated house under 100 is getting harder for sure. Yeah. Do you recommend using a HELOC to purchase? Yes, if you can, however you can get money, get it fixed, as long as you can get it fixed and, for a certain amount of time and get some cash flowing properties, however you can do it, do it. Let's see. Wow, almost at the end of the questions. Waco, and talk to our Texas teams to find out about the various markets, because I don't want to pretend I'm an expert. Definitely talk to our Texas team. They know it well. Let's see. Leah said you could still get it in Cincinnati, Cleveland, Birmingham, and Indianapolis under 100. That's amazing. Okay, I think we got through the questions. We're at an hour 20. Thank you so much, everyone, for all your questions. So happy to have you here. I hope I got to meet some of you at the 3 events I was at last week, or 4, I think it was. If not, we are planning a January event, and really look forward to making sure you get information on that soon. All right, have a wonderful day, everyone, and we'll see you soon. Bye-bye.